Question 1. To address the challenge of managing a high volume of client inquiries and policy servicing requests while ensuring thoroughness and compliance, which of the following time management strategies would be most effective for a certified professional insurance agent? Option A. Delegating all client follow-up tasks and administrative duties to an unlicensed assistant without direct oversight. Option B. Focusing primarily on prospecting for new business during peak client service hours, deferring existing client needs to less busy periods. Option C. Responding to all client communications in the order they are received, regardless of the nature or urgency of the request. Option D. Implementing a tiered system for client inquiries, categorizing them by urgency and complexity, and scheduling dedicated time blocks for in-depth client consultations and policy reviews. The correct answer is D. Implementing a tiered system for client inquiries, categorizing them by urgency and complexity, and scheduling dedicated time blocks for in-depth client consultations and policy reviews. Explanation. Scenario analysis. The scenario presents a common professional challenge for insurance agents, balancing the need for thorough client service with the practical constraints of time. Agents are ethically and often legally obligated to provide accurate advice, understand client needs, and ensure policy suitability. Failure to do so can lead to E&O claims, regulatory sanctions, and damage to professional reputation. The pressure to serve a high volume of clients or meet sales targets can tempt agents to cut corners, making effective time management crucial for maintaining professional integrity and client trust. Correct approach analysis. The correct approach involves proactively structuring the agent's workflow to maximize efficiency without compromising client care. This includes implementing a system for pre-screening client inquiries to identify urgent needs versus routine requests, dedicating specific blocks of time for client consultations, and utilizing technology for administrative tasks. This method ensures that each client receives appropriate attention, regulatory requirements for disclosure and suitability are met, and the agent can manage their workload effectively. From a regulatory perspective, this approach aligns with the duty of care owed to clients, which necessitates providing adequate time for understanding their needs and explaining policy details, thereby preventing misrepresentation or omission of material facts. It also supports compliance with state insurance regulations that mandate agents act in the best interest of the client. Incorrect approaches analysis. One incorrect approach is to address client inquiries on a purely first-come, first-served basis without any prioritization. This can lead to urgent client needs being delayed, potentially resulting in coverage gaps or financial harm to the client, which is a breach of the agent's duty of care and could violate regulations requiring prompt service. Another incorrect approach is to delegate complex client needs to junior staff without adequate supervision or review. This risks miscommunication, incorrect advice, and noncompliance with regulations that hold the licensed agent responsible for the actions of their subordinates. Finally, an approach that prioritizes administrative tasks and internal meetings over direct client interaction, especially for new business or complex policy reviews, can lead to missed opportunities and a failure to adequately assess client needs, potentially resulting in non-compliant sales and regulatory scrutiny. Professional reasoning. Insurance agents must develop a systematic approach to time management that prioritizes client needs and regulatory compliance. This involves a combination of effective scheduling, task delegation with oversight, and leveraging technology. A professional agent will regularly review their workflow to identify bottlenecks and areas for improvement, ensuring that client service remains paramount while operational efficiency is maintained. The decision-making process should always start with the client's best interest and regulatory obligations. Then consider how to best achieve these through optimized time allocation and resource management. Question 2. Analysis of an insurance agent's social media marketing strategy reveals several proposed content types. Which of the following approaches best aligns with regulatory compliance for insurance advertising? Option A. Featuring a brief, attention-grabbing claim about a policy's unique benefit, omitting any necessary disclosures or disclaimers about its applicability. Option B. Developing content that accurately describes policy features and benefits, ensuring all necessary disclosures and licensing information are clearly and conspicuously presented. Option C. Posting comparative advertisements that emphasize perceived weaknesses of competitor products without providing verifiable data to support the claims. Option D. Sharing client testimonials that highlight positive experiences without explicitly stating policy limitations or specific coverage details. The correct answer is D. Sharing client testimonials that highlight positive experiences without explicitly stating policy limitations or specific coverage details. Explanation: this scenario presents a professional challenge because social media marketing, while offering broad reach, is heavily regulated to protect consumers from misleading or deceptive advertising. Insurance agents must balance the desire to promote their services with strict adherence to advertising rules, which often include specific disclosure requirements and prohibitions against making unsubstantiated claims. Failure to comply can result in significant penalties, reputational damage, and loss of licensure. The correct approach involves ensuring all social media content is reviewed for compliance with state insurance advertising regulations and any applicable federal guidelines, such as those from the FTC. This includes verifying that any claims made are accurate, not misleading, and that necessary disclaimers or disclosures are prominently displayed. For instance, if an agent highlights a specific policy benefit, they must also ensure that any limitations or conditions associated with that benefit are clearly communicated, preventing the impression that the benefit is universally available or without exception. This meticulous attention to detail aligns with the ethical duty to provide accurate information and the regulatory mandate to prevent deceptive practices in insurance marketing. An incorrect approach that involves posting testimonials without verifying their authenticity or ensuring they do not imply guaranteed outcomes is problematic. Regulatory bodies often require that testimonials be genuine and representative, and they cannot be used to suggest that past performance guarantees future results, which is particularly relevant in insurance where future events are uncertain. Another incorrect approach: posting comparative advertising that disparages competitors without factual basis or proper substantiation, violates regulations against unfair or deceptive advertising practices. Such claims must be demonstrably true and presented in a manner that is not misleading to consumers. Finally, an approach that omits required licensing information or contact details for the agency or agent on social media posts fails to meet disclosure requirements, which are crucial for consumer protection and regulatory oversight. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of all applicable advertising regulations before engaging in social media marketing. This involves proactive review of all content, seeking legal or compliance department approval for potentially sensitive claims, and maintaining a record of all marketing materials and their compliance checks. When in doubt, err on the side of caution and consult with compliance experts or legal counsel. Question 3. The investigation demonstrates that a certified professional insurance agent, CPIA, is assisting a long-term client with a health insurance policy. The client expresses a desire to switch to a new policy that appears to offer a lower monthly premium, but the agent has concerns that the new policy may have higher deductibles and co-pays, and potentially less comprehensive coverage for the client's specific medical conditions. The agent needs to determine the most appropriate course of action. Which of the following approaches best aligns with regulatory requirements and professional ethical standards for this situation? Option A. Immediately process the client's request to switch to the new policy, as the client has explicitly stated their preference for a lower monthly premium, and the agent's role is to facilitate the client's wishes. Option B. Recommend the new policy to the client, emphasizing the lower monthly premium as the primary benefit, and downplaying any potential drawbacks related to deductibles or co-pays to ensure the client makes the desired change quickly. Option C. Conduct a thorough review of the client's current health status, financial situation, and coverage needs, then present a detailed comparison of the client's existing policy and the proposed new policy, highlighting all differences in premiums, deductibles, co-pays, coverage limits, and potential impact on pre-existing conditions, ensuring the client fully understands all implications before making a decision. Option D. Advise the client that switching policies is generally not advisable due to potential complications with pre-existing conditions, and encourage them to maintain their current coverage without exploring the new policy specifics. The correct answer is C. Conduct a thorough review of the client's current health status, financial situation, and coverage needs, Then present a detailed comparison of the client's existing policy and the proposed new policy, highlighting all differences in premiums, deductibles, co-pays, coverage limits, and potential impact on pre-existing conditions, ensuring the client fully understands all implications before making a decision. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance client needs with regulatory compliance and ethical obligations when dealing with health insurance policy changes. The agent must ensure that any proposed changes are in the client's best interest and fully compliant with all applicable state insurance laws and regulations, particularly those governing policy modifications and disclosure requirements. A failure to do so can lead to significant legal and ethical repercussions, including license suspension or revocation, fines, and damage to professional reputation. The correct approach involves a thorough review of the client's current health status, financial situation, and coverage needs, followed by a detailed explanation of all available policy options, including their benefits, limitations, costs, and any potential impact on pre-existing conditions or deductibles. This approach prioritizes informed consent and ensures the client can make a decision that is both suitable for their circumstances and legally sound. It directly aligns with the agent's fiduciary duty to act in the client's best interest and the regulatory mandate for transparency and accuracy in insurance transactions. Specifically, state insurance regulations typically require agents to provide accurate information about policy terms, conditions, and benefits, and to ensure that any recommended policy is suitable for the client's needs. An incorrect approach that involves immediately recommending a new policy based solely on a perceived cost saving without a comprehensive needs assessment fails to uphold the agent's duty of care and suitability. This approach risks placing the client in a policy that does not adequately meet their health needs, potentially leading to coverage gaps or unexpected out-of-pocket expenses, which violates ethical principles and specific regulations requiring suitability. Another incorrect approach, which is to simply process the client's request for a specific policy change without verifying its appropriateness or explaining potential consequences, demonstrates a lack of diligence and professional responsibility. This can lead to the client making an uninformed decision, exposing them to risks and potentially violating regulations that require agents to advise clients on the implications of policy changes. Finally, an approach that involves pressuring the client to accept a particular policy change by downplaying the benefits of their current coverage or exaggerating the advantages of the new policy is unethical and likely violates regulations against misrepresentation and deceptive practices. This manipulative tactic undermines the client's autonomy and trust and can result in severe regulatory penalties. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the client's situation and needs. This should be followed by a diligent exploration of all viable options, ensuring full transparency regarding terms, benefits, and costs. The agent must then clearly communicate these options, empowering the client to make an informed decision. Throughout this process, adherence to all relevant state insurance laws and ethical guidelines is paramount. Question 4. During the evaluation of a new marketing campaign intended for a multi-state rollout, an insurance agent discovers that proposed advertisements contain testimonials and comparative pricing information. The agent is licensed in several states, and the insurer's home office is in a different state. The agent needs to ensure the campaign adheres to all applicable state insurance regulations. Which of the following actions represents the most prudent and compliant approach? Option A. Rely on general industry best practices for advertising and testimonials, as these are widely understood and typically sufficient for consumer protection across most states. Option B. Inform the insurer's marketing department that the advertisements may violate certain state laws and request they revise the materials based on the agent's general understanding of insurance advertising rules. Option C. Conduct a thorough review of each state's specific insurance code and advertising regulations to confirm compliance with rules on testimonials, comparative pricing, and producer disclosures before launching the campaign in any state. Option D. Proceed with the campaign as drafted, assuming that if the insurer's legal department approved it, it meets all necessary state requirements, and the agent's multi-state license covers the activity. The correct answer is D. Proceed with the campaign as drafted, assuming that if the insurer's legal department approved it, It meets all necessary state requirements, and the agent's multi-state license covers the activity. Explanation. This scenario presents a professional challenge because insurance agents operate under a complex web of state regulations designed to protect consumers and ensure fair market practices. Misinterpreting or disregarding these regulations can lead to severe consequences, including fines, license suspension or revocation, and damage to the agent's reputation and the insurer's standing. The agent must exercise careful judgment to navigate these requirements accurately. The correct approach involves diligently researching and adhering to the specific state's laws regarding advertising and producer licensing. This means verifying that all marketing materials comply with state statutes concerning disclosures, prohibited practices, and the accurate representation of insurance products and producer authority. It also necessitates confirming that the producer's license is active and in good standing in the state where the advertisement is being disseminated and where the policy is being sold. This adherence is mandated by state insurance departments, which are responsible for enforcing these consumer protection laws. An incorrect approach would be to assume that advertising practices acceptable in one state are automatically permissible in another. Each state has its own unique insurance code and regulations, and failing to verify compliance with the specific state's laws is a direct violation of the principle of jurisdictional compliance. This oversight can lead to accusations of deceptive advertising or operating without proper licensing, both of which carry significant penalties under state insurance law. Another incorrect approach is to rely solely on the insurer's marketing department for compliance without independent verification. While insurers have compliance departments, the ultimate responsibility for adhering to state regulations often rests with the individual producer. Delegating this responsibility entirely without due diligence can result in overlooking state-specific nuances that the insurer's general materials might not address. This failure to exercise independent professional judgment and due diligence is a regulatory and ethical lapse. A further incorrect approach is to proceed with advertising based on past practices or general industry knowledge without confirming current state-specific requirements. Insurance laws and regulations are subject to change, and what was acceptable previously may no longer be. This lack of proactive verification demonstrates a disregard for the dynamic nature of regulatory compliance and exposes the agent and insurer to potential violations. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify the specific state, S, where the advertising will be seen and where business will be conducted. 2. Consult the relevant state's Department of Insurance website or statutes for regulations pertaining to insurance advertising and producer licensing. 3. Review all marketing materials for compliance with these specific state requirements, paying close attention to disclosure mandates, prohibited content, and accuracy. 4. Verify the current status of the producer's license in each relevant state. 5. If there is any uncertainty, seek clarification from the state's Department of Insurance or legal counsel specializing in insurance law. 6. Document all compliance efforts and research. Question 5. The control framework reveals that an insurance agent is assisting a client who is seeking coverage for a specific, high-risk business operation. The client is eager to secure a policy quickly and has expressed a desire for minimal premium, even if it means overlooking certain policy details. The agent is aware that the proposed policy has significant exclusions related to the very type of risk the client is most concerned about, but believes that by emphasizing the policy's broad coverage statements and downplaying the exclusions, they can close the sale and meet their sales targets. What is the most appropriate course of action for the agent? Option A. Recommend a policy that is significantly beyond the client's financial capacity but offers extensive coverage, hoping the client will find a way to afford it. Option B. Emphasize the policy's general coverage statements and downplay the significance of the exclusions to secure the sale quickly, assuming the client will understand the details later or that the exclusions are unlikely to be invoked. Option C. Fully disclose all policy exclusions and limitations to the client. Explain the implications of these exclusions on the client's specific risk, and recommend a policy that genuinely matches the client's needs and risk profile, even if it means a higher premium or a different product. Option D. Focus solely on meeting the company's sales targets for the quarter by pushing the most profitable policy, regardless of its suitability for the client's specific high-risk operation. Correct answer is C. Fully disclose all policy exclusions and limitations to the client. Explain the implications of these exclusions on the client's specific risk, and recommend a policy that genuinely matches the client's needs and risk profile, even if it means a higher premium or a different product. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the immediate financial interests of a client with the long-term solvency and regulatory compliance of the insurance company. Agents have a fiduciary duty to their clients, but also a responsibility to operate within the legal and ethical boundaries set by insurance regulations. Misinterpreting or ignoring these boundaries can lead to severe consequences for both the agent and the company. The correct approach involves prioritizing the client's genuine needs and understanding of risk, while ensuring that the proposed policy aligns with the insurer's underwriting guidelines and regulatory requirements. This means thoroughly assessing the client's situation, explaining policy limitations and benefits accurately, and recommending a product that is suitable and not misrepresented. This approach is ethically sound and legally compliant, as it upholds the principles of fair dealing, transparency, and suitability, which are cornerstones of insurance regulation designed to protect consumers and maintain market integrity. An incorrect approach that involves downplaying or omitting crucial policy exclusions to secure a sale is ethically reprehensible and violates regulatory mandates for full disclosure. This misrepresentation can lead to claims disputes, financial harm to the policyholder, and regulatory sanctions against the agent and insurer for deceptive practices. Another incorrect approach, which is to push a policy that clearly exceeds the client's financial capacity or risk tolerance, demonstrates a failure to act in the client's best interest. This not only breaches ethical obligations, but can also lead to policy lapse, customer dissatisfaction, and potential claims of mis-selling, all of which are subject to regulatory scrutiny. Finally, an approach that prioritizes company sales targets over client suitability, even if technically compliant with product features, can still be ethically problematic if it leads to a pattern of placing unsuitable business, potentially violating broader principles of fair treatment of customers. Professionals should employ a decision-making framework that begins with a thorough understanding of client needs and risk profile. This should be followed by a comprehensive review of available products, ensuring full comprehension of policy terms, conditions, and exclusions. The agent must then assess the suitability of the product for the client's specific circumstances and communicate all relevant information transparently and honestly. If a product does not meet the client's needs, or if there are concerns about suitability or compliance, the agent must escalate the issue or decline the business, rather than resorting to misrepresentation or pressure tactics. Question 6. Cost-benefit analysis shows that adopting certain consumer protection provisions outlined in National Association of Insurance Commissioners (NAIC) model laws, which are not yet explicitly mandated by the agent's specific state, might incur minor administrative costs. However, a new product offering presents a significant commission opportunity. Considering the agent's professional obligations and the role of NAIC guidelines in promoting sound insurance practices, which of the following approaches best reflects responsible professional conduct? Option A. Proactively implement the NAIC model provisions to ensure the highest standard of consumer protection, anticipating potential future regulatory alignment and upholding ethical principles. Option B. Assume that the absence of a specific state law mirroring a NAIC model implies that the less protective practice is acceptable, prioritizing the commission opportunity. Option C. Implement the NAIC model provisions only if the state has indicated imminent adoption, otherwise proceed with the minimum state requirements to capture the commission opportunity. Option D. Only adhere to the explicit laws of the state, disregarding NAIC model provisions not yet adopted, to maximize immediate commission potential and minimize administrative effort. The correct answer is A. Proactively implement the NAIC model provisions to ensure the highest standard of consumer protection, anticipating potential future regulatory alignment, and upholding ethical principles. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to balance the immediate financial benefits of a new product with the long-term implications of regulatory compliance and consumer trust. The pressure to meet sales targets or secure a lucrative commission can create a conflict of interest, making it difficult to objectively assess the suitability of a product for all clients. Agents must exercise sound judgment to ensure that their recommendations are not driven by personal gain, but by the best interests of the insured, adhering strictly to the principles of fair dealing and fiduciary responsibility, even when not explicitly mandated as fiduciaries in all contexts. Correct approach analysis. The correct approach involves prioritizing the agent's duty to understand and adhere to the National Association of Insurance Commissioners, NAIC, model laws and guidelines, particularly those related to consumer protection and fair sales practices, even when a specific state has not yet adopted a particular model law. This proactive stance demonstrates a commitment to ethical conduct and a thorough understanding of the evolving regulatory landscape. By aligning practices with NAIC models, agents ensure they are operating at a high standard of care, anticipating potential future regulatory changes, and safeguarding against potential consumer harm. This approach is justified by the NAIC role in promoting uniformity and best practices across state insurance regulation, aiming to protect consumers and ensure market stability. Adhering to these models, even in the absence of direct state mandate, reflects a commitment to the spirit of consumer protection that underpins all insurance regulation. Incorrect approaches analysis. An approach that relies solely on the absence of a specific state law mirroring a NAIC model to justify a less consumer protective practice is ethically and regulatorily flawed. This ignores the underlying principles of consumer protection that NAIC models are designed to embody and can lead to practices that, while not explicitly illegal in that moment, are considered unfair or deceptive by industry standards and could be subject to future regulatory action or legal challenge. It also fails to consider the potential for reputational damage and loss of client trust. Another incorrect approach is to assume that compliance with minimum state requirements is sufficient, without considering the broader ethical implications or the guidance provided by NAIC models. This can lead to a bare minimum approach that may not adequately protect consumers or align with the evolving expectations of regulators and the public. It overlooks the NAIC role in setting a benchmark for responsible insurance practices. Finally, an approach that prioritizes immediate commission or sales goals over a thorough understanding and application of NAIC guidelines, even if not directly mandated by state law, is a failure of professional responsibility. This demonstrates a lack of commitment to consumer welfare and can result in misrepresentation, unsuitable sales, and ultimately, harm to the client, which is contrary to the fundamental purpose of insurance regulation. Professional reasoning. Professionals should adopt a proactive and principle-based approach to regulatory compliance. This involves not only understanding the specific laws of their licensed states, but also staying informed about NAIC model laws and guidelines. When a state has not yet adopted a particular NAIC model, professionals should evaluate whether adopting the principles of that model would enhance consumer protection and align with ethical best practices. The decision-making process should involve a risk assessment, considering potential consumer harm, reputational damage, and future regulatory trends. Prioritizing consumer interests and ethical conduct, even when not strictly mandated by law, is the hallmark of a responsible insurance agent. Question 7. Comparative studies suggest that in resolving policyholder-insurer disputes, insurance agents often face ethical and regulatory dilemmas. Considering the Certified Professional Insurance Agent (CPIA) framework, which approach best exemplifies professional best practice when a policyholder disputes the insurer's interpretation of a coverage clause. Option A. The agent should immediately advise the policyholder to seek legal counsel and withdraw from further involvement in the dispute. Option B. The agent should inform the policyholder that policy interpretation is solely the insurer's responsibility and that the agent cannot intervene in such matters. Option C. The agent should strongly advocate for the policyholder's interpretation, leveraging their relationship with the insurer to pressure for a favorable outcome for the policyholder. Option D. The agent should act as a neutral facilitator, gathering all relevant policy information and communications, and presenting them clearly to both parties to encourage a mutually agreeable resolution. The correct answer is A. The agent should immediately advise the policyholder to seek legal counsel and withdraw from further involvement in the dispute. Explanation. This scenario is professionally challenging because it requires an insurance agent to navigate a complex dispute between a policyholder and an insurer, where the agent's actions could significantly impact the outcome and potentially expose them to regulatory scrutiny or legal liability. agent must balance their duty to the client with their obligations to the insurer and regulatory bodies, all while adhering to specific jurisdictional laws and ethical guidelines. Careful judgment is required to ensure fair resolution and maintain professional integrity. The correct approach involves the agent acting as a neutral facilitator, gathering all relevant information, and presenting it clearly to both parties to encourage a mutually agreeable resolution. This approach aligns with the agent's role as a professional intermediary, promoting efficient dispute resolution and upholding the principles of fair dealing. Regulatory frameworks, such as those governing producer conduct, often mandate or encourage such collaborative efforts to resolve claims disputes without unnecessary escalation. This method respects the contractual obligations of both the policyholder and the insurer, while leveraging the agent's unique position to bridge communication gaps. An incorrect approach would be for the agent to take sides definitively and advocate solely for the policyholder's interpretation of the policy, pressuring the insurer to concede. This violates the agent's duty of impartiality and could be seen as acting outside the scope of their license, potentially misrepresenting the insurer's position or engaging in unfair claims settlement practices, which are prohibited by most insurance regulations. Another incorrect approach would be for the agent to ignore the dispute, assuming it is solely between the policyholder and the insurer. Failure to act or facilitate communication can be construed as a dereliction of duty, especially if the agent possesses information that could aid in resolution, or if the policyholder reasonably expects the agent's assistance. Such inaction could lead to regulatory penalties for failing to act in good faith or to assist in the proper handling of a claim. Finally, an incorrect approach would be for the agent to offer legal advice or interpret policy language in a manner that constitutes legal counsel. Insurance agents are typically not licensed attorneys, and providing legal advice is outside their scope of practice and licensing authority. Doing so could lead to unauthorized practice of law charges and significant liability for both the agent and their agency. The professional decision-making process for similar situations should involve 1. Understanding the nature of the dispute and the agent's role. 2. Gathering all pertinent facts and policy documentation. 3. Communicating clearly and impartially with both the policyholder and the insurer. 4. Facilitating information exchange and negotiation. 5. Knowing when to advise parties to seek independent legal counsel. And 6. Adhering strictly to all applicable laws, regulations, and ethical codes governing insurance producers. Question 8. The performance metrics show a significant increase in claims filed by a particular client's employees over the past year, yet the client has consistently reported low-risk operations during their annual policy renewals. As a certified professional insurance agent, CPIA, what is the most appropriate risk assessment approach to ensure compliance with state workers' compensation laws and protect both the client and the insurer? Option A. Conduct an immediate, thorough on-site inspection of the client's business operations to identify potential hazards and verify reported risk classifications. Option B. Accept the client's self-reported operational data as accurate and continue with the current policy terms, assuming the claims are isolated incidents. Option C. Advise the client to implement additional safety protocols and wait to reassess the risk until the next policy renewal cycle. Option D. Focus on finding a new insurer who offers a lower premium for the client's reported risk profile, regardless of the claim history. The correct answer is A. Conduct an immediate, thorough on-site inspection of the client's business operations to identify potential hazards and verify reported risk classifications. Explanation. This scenario presents a professional challenge because it requires the insurance agent to balance client needs with the stringent requirements of state workers' compensation laws, specifically concerning risk assessment and reporting. The agent must understand that failure to accurately assess and report risk can lead to significant legal and financial repercussions for both the client and the agency. The correct approach involves a thorough, on-site risk assessment that directly engages with the employer's operations to identify potential hazards and their severity. This aligns with the fundamental principles of workers' compensation insurance, which is designed to cover work-related injuries and illnesses. State laws mandate that insurers accurately classify employers and their employees to ensure appropriate premium collection and coverage. A proactive, on-site assessment is the most reliable method to achieve this accuracy, fulfilling the insurer's duty to underwrite responsibly and the employer's obligation to provide a safe workplace and accurate information. This approach directly addresses the regulatory requirement to classify risk accurately, which is the bedrock of workers' compensation underwriting. An incorrect approach that relies solely on the employer's self-reported information without independent verification is professionally unacceptable. This fails to meet the regulatory obligation to conduct a proper risk assessment. State workers' compensation laws expect insurers to exercise due diligence in understanding the risks they are insuring. Relying solely on the employer's potentially incomplete or biased information can lead to misclassification, underpayment of premiums, and inadequate coverage, violating the spirit and letter of the law. Another incorrect approach that involves delaying the risk assessment until after a claim is filed is also professionally unsound. This demonstrates a reactive rather than proactive stance, which is contrary to the principles of sound insurance practice and regulatory expectations. Workers' compensation laws are designed to prevent injuries and ensure prompt benefits when they occur. A delayed assessment means the risk was not properly understood or priced from the outset, potentially leaving the employer underinsured and the insurer exposed to unforeseen liabilities. This failure to assess risk upfront is a direct contravention of underwriting best practices and regulatory oversight. Finally, an approach that focuses only on the lowest premium without a corresponding assessment of the actual risk is a critical ethical and regulatory failure. Insurance premiums are directly tied to the assessed risk. Prioritizing cost savings over accurate risk evaluation can lead to misclassification, where an employer is placed in a lower-risk category than they actually are. This not only defrauds the workers' compensation system by underpaying premiums, but also leaves the employer vulnerable if a claim arises that exceeds the coverage provided by the misclassified risk. The professional decision-making process for similar situations should begin with a clear understanding of the applicable state workers' compensation statutes and the insurer's underwriting guidelines. The agent must prioritize a comprehensive risk assessment that involves direct observation and inquiry into the employer's operations. This assessment should inform the classification and rating process. Any discrepancies or potential issues identified during the assessment must be addressed with the employer and documented thoroughly. The ultimate goal is to ensure accurate coverage, fair premium, and compliance with all legal and ethical obligations. Question 9. Investigation of an insurance agency owner's response to a significant, unexpected increase in operational costs, which is threatening the agency's immediate solvency, requires understanding the most appropriate and compliant course of action. The owner is considering several immediate measures to address the financial shortfall. Option A. Explore opportunities to offer new, compliant insurance products or services that align with the agency's existing licenses and expertise to generate additional revenue. Option B. Delay remitting collected premiums to insurers for a short period, retain cash flow within the agency. Option C. Temporarily use a portion of collected client premiums to cover essential operating expenses, with the intention of repaying the funds once the financial situation stabilizes. Option D. Immediately seek a business line of credit from a reputable financial institution to bridge the funding gap. The correct answer is C. Temporarily use a portion of collected client premiums to cover essential operating expenses, with the intention of repaying the funds once the financial situation stabilizes. Explanation. This scenario presents a professional challenge because an insurance agency owner must balance the immediate financial needs of their business with their fiduciary duty to clients and the regulatory obligations imposed by the state. The agency's financial health is directly tied to its ability to operate and serve its clients, but any action that compromises client trust or violates regulations can lead to severe penalties, including license revocation and reputational damage. Careful judgment is required to ensure that business decisions are both financially sound and ethically and legally compliant. The correct approach involves prioritizing the agency's financial stability through legitimate and transparent means, such as exploring operational efficiencies, seeking new business lines within regulatory boundaries, or securing a business loan. This approach upholds the agency's fiduciary responsibilities by ensuring it can continue to serve its clients effectively and meet its obligations. It aligns with regulatory frameworks that expect agencies to be financially sound and to operate with integrity, avoiding any actions that could be construed as self-dealing or a breach of trust. An incorrect approach would be to use client premium funds for operational expenses before they are remitted to the insurer. This is a direct violation of trust and regulatory statutes governing the handling of fiduciary funds. Such an action constitutes commingling or misappropriation of client funds, which carries severe penalties, including criminal charges, license suspension or revocation, and significant fines. It erodes client confidence and jeopardizes the agency's ability to operate. Another incorrect approach would be to misrepresent the agency's financial situation to clients or the regulatory body to secure favorable terms or avoid scrutiny. This constitutes fraud and dishonesty, violating ethical standards and specific regulations that require accurate reporting and transparency. Such misrepresentation can lead to severe legal consequences and the permanent loss of the agent's license. A third incorrect approach would be to engage in unauthorized financial transactions with client assets, such as investing premium funds in speculative ventures without explicit client consent and proper authorization. This violates the agency's duty of care and loyalty to its clients, as well as specific regulations governing the handling and investment of client funds. It exposes clients to undue risk and the agency to significant liability. The professional decision-making process for similar situations should involve a thorough understanding of all applicable state insurance laws and regulations, particularly those pertaining to agency operations, financial management, and client fund handling. When faced with financial pressure, an agent should first consult their agency's financial statements and operational budget to identify areas for legitimate cost savings or revenue enhancement. If external funding is considered, exploring options like business loans from reputable financial institutions should be the priority. Any proposed action must be evaluated against the agency's fiduciary duties and regulatory obligations. If there is any doubt about the legality or ethical implications of a proposed action, seeking advice from legal counsel specializing in insurance law or consulting with the state's Department of Insurance is crucial before proceeding. Transparency with stakeholders, including clients and regulators, is paramount. Question 10. Strategic planning requires an insurance agency to develop a robust human resources framework. Which of the following approaches best ensures regulatory compliance and ethical operations within the agency? Option A. Implementing comprehensive, written HR policies and procedures that are regularly reviewed and updated to reflect current federal and state employment laws, coupled with ongoing training for all staff. Option B. Developing HR policies only when a specific legal complaint or issue is raised by an employee or regulatory body. Option C. Adopting HR practices that are commonly used by other agencies in the region, assuming these are legally sound. Option D. Relying on informal, verbal agreements for all employment-related matters and addressing issues as they arise on a case-by-case basis. Correct answer is A. Implementing comprehensive, written HR policies and procedures that are regularly reviewed and updated to reflect current federal and state employment laws, coupled with ongoing training for all staff. Explanation. This scenario is professionally challenging because insurance agencies, like all businesses, must navigate complex human resources regulations to ensure fair treatment of employees and avoid legal repercussions. The CPIA designation emphasizes ethical conduct and regulatory compliance, making HR practices a critical area of focus. Careful judgment is required to balance business needs with legal obligations and employee well-being. The correct approach involves proactively establishing and consistently applying clear, written policies that align with all applicable federal and state employment laws. This includes, but is not limited to, laws concerning hiring, compensation, discrimination, harassment, and termination. Regular training for managers and employees on these policies and relevant laws is essential for fostering a compliant and ethical workplace. This approach is right because it demonstrates a commitment to legal and ethical standards, minimizes the risk of lawsuits and regulatory penalties, and promotes a positive and productive work environment. Specifically, adherence to regulations like the Civil Rights Act of 1964, the Americans with Disabilities Act, and the Fair Labor Standards Act, as enforced by agencies like the Equal Employment Opportunity Commission and the Department of Labor, is paramount. An incorrect approach would be to rely solely on verbal agreements and informal practices for HR matters. This fails to provide a clear framework, leading to inconsistencies and potential misunderstandings that can easily violate employment laws. It creates a high risk of discrimination claims and other legal challenges due to the lack of documented procedures and evidence of fair treatment. Another incorrect approach is to only address HR issues reactively, waiting for a problem to arise before implementing a policy. This reactive stance often results in hasty, potentially non-compliant solutions that do not adequately address the root cause and can still lead to legal entanglements. It signals a lack of foresight and commitment to a well-managed HR function. A third incorrect approach is to assume that industry best practices alone are sufficient without verifying their alignment with specific legal requirements. While best practices can be a good starting point, they do not replace the necessity of understanding and adhering to the letter of the law, which can vary significantly by jurisdiction and evolve over time. Professionals should adopt a proactive and systematic approach to HR. This involves staying informed about current employment laws, developing comprehensive written policies and procedures, ensuring these are communicated effectively to all staff, and providing regular training. When faced with an HR decision, professionals should consult their documented policies, relevant legal statutes, and if necessary, seek legal counsel to ensure compliance and ethical conduct. Question 11. Compliance review shows that an insurance agent, while discussing a client's upcoming policy renewal, learns of a significant change in the client's business operations that could impact their insurance needs. The agent believes a different type of coverage, not currently held by the client, would be more appropriate and potentially save the client money. However, this information was shared in a casual conversation and not explicitly authorized for use in advising on insurance matters. Which of the following represents the most professional and compliant course of action for the agent? Option A. Contact the client's business partner, who is also an insured, to confirm the operational changes and discuss alternative coverage options. Option B. Inform the client that the agent has learned of a potential issue with their coverage and ask for explicit permission to discuss how recent business changes might affect their insurance needs, explaining that this discussion would involve leveraging information shared in confidence. Option C. Immediately advise the client that their current coverage is inadequate and recommend the new policy, explaining the potential benefits based on the overheard information. Option D. Proceed with renewing the client's existing policy as planned, as no explicit request was made to review coverage based on new business information. Correct answer is C. Immediately advise the client that their current coverage is inadequate and recommend the new policy, explaining the potential benefits based on the overheard information. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance client needs with regulatory obligations and ethical conduct. The agent is privy to information that could benefit a client, but also potentially violate confidentiality or create a conflict of interest. Navigating this requires a deep understanding of professional responsibilities, including the duty of care, confidentiality, and avoiding misrepresentation. The correct approach involves prioritizing the client's best interests while strictly adhering to regulatory requirements and ethical principles. This means obtaining informed consent before disclosing any information, even if it seems beneficial. The agent must act with integrity, ensuring transparency and avoiding any action that could be construed as self-serving or detrimental to the client's trust. This aligns with the core tenets of professionalism in insurance, emphasizing client welfare and ethical conduct above all else. An incorrect approach would be to disclose the information without explicit consent, even with good intentions. This violates the fundamental principle of client confidentiality, which is a cornerstone of professional insurance practice and often mandated by regulations. Such an action erodes trust and can lead to disciplinary action. Another incorrect approach is to ignore the information or fail to act on it in a way that respects client confidentiality. While avoiding a breach, this could also be seen as a failure to act in the client's best interest if the information could genuinely help them, and the agent has a duty to advise. The agent must find a way to leverage the information ethically and legally. A third incorrect approach is to use the information for personal gain or to steer the client towards a product that benefits the agent more than the client. This constitutes a conflict of interest and a breach of fiduciary duty, undermining the agent's professional integrity and violating ethical guidelines. The professional decision-making process in such situations should involve a clear assessment of the ethical and regulatory implications. The agent should first identify the core ethical principles at play, e.g., confidentiality, honesty, client welfare. Then, they should consider relevant regulations and company policies. Finally, they should evaluate potential courses of action based on their adherence to these principles and regulations, always erring on the side of caution and transparency with the client. Seeking guidance from supervisors or compliance departments is also a crucial step when uncertainty exists. Question 12. The review process indicates that a client is considering two life insurance options, a whole life policy and a universal life policy. The agent has noted that the commission on the whole life policy is slightly higher. The client has expressed a desire for lifelong coverage, but is also concerned about flexibility in premium payments due to fluctuating income. Which approach best demonstrates the agent's adherence to regulatory and ethical obligations? Option A. Emphasizing the higher commission available on the whole life policy to motivate the client towards that option, while assuring them it meets their lifelong coverage needs. Option B. Recommending the whole life policy due to its guaranteed death benefit and cash value growth, while briefly mentioning the universal life policy's flexibility as a secondary consideration. Option C. Recommending the universal life policy because it offers more flexibility, which is a key client concern, without extensively detailing the guaranteed aspects of the whole life policy. Option D. Presenting both policies with a detailed comparison of their features, benefits, costs, and flexibility, and then guiding the client to choose the policy that best aligns with their stated need for lifelong coverage and their concern about premium payment flexibility. The correct answer is B. Recommending the whole life policy due to its guaranteed death benefit and cash value growth, while briefly mentioning the universal life policy's flexibility as a secondary consideration. Explanation. This scenario is professionally challenging because it requires the agent to navigate the nuanced differences between two life insurance policy types, ensuring the client's understanding and suitability are paramount. Rather than simply fulfilling a sales quota, the agent must prioritize client needs and regulatory compliance over potential personal gain. The correct approach involves clearly differentiating the two policy types, highlighting their distinct features, benefits, and costs, and then guiding the client to select the option that best aligns with their stated financial goals, risk tolerance, and long-term needs. This aligns with the fundamental ethical duty of acting in the client's best interest and the regulatory requirement for suitability. Agents are obligated to provide accurate and understandable information to enable informed decision-making, preventing misrepresentation or omission of material facts. An incorrect approach would be to focus solely on the commission structure or the ease of selling one policy over the other, without a thorough needs analysis. This demonstrates a failure to uphold the duty of care and suitability, potentially leading to a policy that does not meet the client's objectives and could result in regulatory scrutiny for misrepresentation or unethical sales practices. Another incorrect approach would be to present the policies in a way that downplays the differences or exaggerates the benefits of one without a clear, client-centric rationale. This constitutes a failure to provide complete and accurate information, violating disclosure requirements and the principle of transparency. Professionals should approach such situations by first conducting a comprehensive needs analysis, followed by a clear, objective presentation of suitable product options. The decision-making process should be driven by the client's best interests, supported by thorough documentation of the needs analysis and the rationale for the recommended product. Agents must be prepared to explain the differences between products in plain language and ensure the client fully understands their choices before making a decision. Question 13. Risk assessment procedures indicate a significant increase in climate-related events and cyber threats impacting businesses. As a certified professional insurance agent, CPIA, which approach best aligns with current industry trends and regulatory expectations for client risk assessment? Option A. Advise clients that coverage for emerging risks is typically speculative and outside the scope of standard insurance policies. Option B. Continue to offer only traditional property and casualty policies that have historically met client needs, without exploring new endorsements or specialized coverages. Option C. Proactively research and integrate knowledge of emerging risks like climate change and cyber threats into client risk assessments and coverage recommendations. Option D. Focus exclusively on historical claims data to determine coverage needs, as this reflects proven risk patterns. Correct answer is D. Focus exclusively on historical claims data to determine coverage needs, as this reflects proven risk patterns. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to navigate evolving industry trends and their impact on risk assessment without relying on outdated methodologies. The pressure to maintain client satisfaction and regulatory compliance while adapting to new risks necessitates a proactive and informed approach. Failure to do so can lead to inadequate coverage, financial losses for clients, and potential E&O claims against the agent. Correct approach analysis. The correct approach involves proactively researching and understanding emerging risks, such as those associated with climate change and cyber threats, and integrating this knowledge into client risk assessments. This aligns with the CPIA ethical obligation to act in the client's best interest and to maintain a high level of professional competence. Regulatory frameworks, while not always explicitly detailing every emerging risk, mandate that agents provide advice and solutions that are suitable for the client's needs, which inherently includes considering foreseeable future risks. This approach demonstrates due diligence and a commitment to providing comprehensive insurance solutions. Incorrect approach is analysis. An approach that relies solely on historical data without considering future trends is professionally unacceptable. This fails to meet the standard of care expected of a competent insurance professional, as it ignores the dynamic nature of risk. It can lead to clients being underinsured against new or escalating threats, violating the principle of acting in the client's best interest, and potentially breaching regulatory requirements for adequate coverage. An approach that dismisses emerging risks as speculative or outside the scope of standard insurance coverage is also flawed. While some risks may be novel, a responsible agent must assess their potential impact and explore available coverage options, or advise clients on risk mitigation strategies. Ignoring these risks can be seen as a failure to provide sound professional advice and can expose the agent to E&O liability. An approach that prioritizes selling existing, familiar products over adapting to new risk landscapes is a direct conflict with the client's needs. This approach prioritizes the agent's convenience or commission over the client's protection, which is an ethical breach and can lead to regulatory scrutiny for misrepresentation or failure to offer suitable coverage. Professional reasoning. Professionals should adopt a continuous learning mindset, actively seeking information on industry trends and emerging risks. When assessing a client's risk profile, they should consider both current exposures and potential future threats. This involves engaging in thorough research, consulting with industry experts, and utilizing resources that provide insights into evolving risk landscapes. The decision-making process should always prioritize the client's best interests, ensuring that their insurance program is comprehensive, current, and adequately addresses their unique risk exposures, both present and foreseeable. Question 14. Assessment of an insurance agent's recommendation for employer's liability coverage for a manufacturing client with 50 employees, considering the agent's primary responsibility to ensure the client is adequately protected against potential claims arising from employee injuries or illnesses not covered by workers' compensation, and the need to comply with all applicable state-specific insurance regulations. Option A. Conduct a thorough assessment of the client's operations, employee classifications, and relevant state statutes to determine appropriate coverage limits and discuss potential exposures beyond workers' compensation, presenting a tailored recommendation that balances protection and cost. Option B. Offer a policy with the minimum legally required limits for employer's liability, emphasizing the cost savings to the client and assuming that workers' compensation will cover most employee-related incidents. Option C. Recommend a policy with the highest available limits of employer's liability coverage, explaining to the client that this provides the broadest protection against potential lawsuits and statutory penalties, regardless of premium cost. Option D. Provide a standard employer's liability policy that is commonly sold to businesses in the manufacturing sector, without conducting a detailed analysis of the client's specific operations or inquiring about any unique employee-related risks. The correct answer is C. Recommend a policy with the highest available limits of employer's liability coverage, explaining to the client that this provides the broadest protection against potential lawsuits and statutory penalties, regardless of premium cost. Explanation. This scenario is professionally challenging because the agent must navigate the complexities of employers' liability coverage, specifically in relation to statutory requirements, and the potential for significant financial and legal repercussions for the employer if coverage is inadequate. The agent's duty is to ensure the client understands their obligations and the available protections, not just to sell a policy. Careful judgment is required to accurately assess the client's risk profile and recommend appropriate coverage that aligns with legal mandates and best practices. The correct approach involves a thorough review of the client's operations, employee classifications, and the specific statutory requirements for employers' liability in their operating jurisdiction. This includes understanding the nuances of how the policy responds to claims arising from employee injuries or illnesses that are not covered by workers' compensation. The agent must then clearly communicate the scope of coverage, limitations, and the importance of maintaining adequate limits based on the potential severity of claims. This aligns with the agent's fiduciary duty to act in the client's best interest and to provide advice that is both compliant with regulations and sound from a risk management perspective. An incorrect approach that focuses solely on the lowest premium without a comprehensive risk assessment fails to uphold the agent's professional responsibility. This oversight can lead to underinsurance, leaving the employer exposed to substantial uninsured losses and potential litigation, which is a direct violation of the duty of care owed to the client. Another incorrect approach that involves providing a generic policy without tailoring it to the specific industry and operational risks of the employer ignores the fundamental principle of risk management. Employers' liability is not a one-size-fits-all product, and failing to customize it can result in gaps in coverage for specific types of employee-related claims, such as those arising from occupational diseases or wrongful termination allegations that might fall under the umbrella of employers' liability in certain contexts. This demonstrates a lack of due diligence and can expose the client to unforeseen liabilities. A further incorrect approach that assumes workers' compensation exclusively covers all employee-related injuries is a critical misunderstanding of insurance principles. While workers' compensation is primary for many workplace injuries, employers' liability coverage is designed to address claims that fall outside its scope, such as those brought by employees in jurisdictions where workers' compensation is not the exclusive remedy, or for specific types of claims like third-party overactions. Failing to explain this distinction leaves the employer vulnerable. Professionals should employ a decision-making framework that prioritizes understanding the client's business and legal obligations. This involves active listening, asking probing questions about operations and workforce, researching relevant statutory requirements, and then recommending coverage that provides robust protection. Regular policy reviews and proactive communication about potential coverage gaps or changes in legislation are also crucial components of professional service. Question 15. Upon reviewing an insurance agency's marketing strategy, which approach best aligns with the ethical and regulatory requirements for professional insurance agents, particularly concerning the accurate representation of insurance products? Option A. Developing marketing materials that emphasize the most attractive potential benefits of a policy while downplaying or omitting less favorable terms and conditions. Option B. Designing promotional campaigns that feature client testimonials, ensuring they are from satisfied customers, without verifying the specific policy details or the typicality of their experience. Option C. Creating marketing content that uses generalized positive statements about insurance coverage without specifying policy details or limitations, relying on the assumption that clients will ask for clarification. Option D. Crafting marketing materials that clearly and accurately describe policy features, benefits, limitations, and costs, ensuring all claims are substantiated and avoid misleading statements. The correct answer is A. Developing marketing materials that emphasize the most attractive potential benefits of a policy while downplaying or omitting less favorable terms and conditions. Explanation. This scenario presents a common challenge in insurance agency marketing, balancing the need to attract new clients with the ethical and regulatory obligations to provide accurate and non-misleading information. The CPIA designation emphasizes professionalism and adherence to ethical standards, making this a critical area for evaluation. The challenge lies in understanding how marketing efforts can inadvertently create unrealistic expectations or misrepresent policy benefits, potentially leading to client dissatisfaction and regulatory scrutiny. The correct approach involves developing marketing materials that are both informative and compliant. This means clearly outlining policy features, limitations, and costs without exaggeration or omission. It requires a thorough understanding of the products being marketed and the target audience's needs, ensuring that all claims are substantiated and align with the actual policy contracts. Regulatory compliance is paramount, as marketing practices are subject to oversight to prevent deceptive or unfair trade practices. Ethical marketing builds trust and long-term client relationships, which is a cornerstone of professional insurance practice. An incorrect approach that focuses solely on highlighting potential benefits without mentioning limitations or exclusions would be ethically flawed and likely violate regulations against deceptive advertising. This creates a misleading impression of coverage. Another incorrect approach that uses testimonials without ensuring their authenticity or relevance to the specific products being offered could also be problematic, as it may not accurately reflect typical client experiences or could be perceived as an endorsement that is not fully representative. Finally, an approach that relies on vague or ambiguous language to describe coverage, leaving room for misinterpretation, fails to meet the standard of clear and honest communication required by regulatory bodies and ethical practice. Professionals should approach marketing by first understanding the specific regulations governing insurance advertising in their jurisdiction. This includes familiarizing themselves with rules regarding unfair trade practices, misrepresentation, and deceptive advertising. They should then develop marketing messages that are truthful, accurate, and not misleading, ensuring that all claims can be substantiated by the policy contract. A review process involving legal or compliance personnel can help identify potential issues before materials are released. Prioritizing transparency and client education over aggressive sales tactics is crucial for maintaining professional integrity and avoiding regulatory penalties. Question 16. The monitoring system demonstrates that a client is requesting a homeowner's insurance policy for a property owned by their adult child, for whom the client wishes to be the sole beneficiary. The client states they want to ensure the property is protected financially, even though they have no ownership stake or legal right to occupy the property. What is the most appropriate course of action for the insurance agent? Option A. Proceed with issuing the policy as requested, assuming the client's intent to protect the property is sufficient to establish an insurable interest. Option B. Recommend the client name their adult child as the insured on the policy, but allow the client to remain as the primary beneficiary to ensure their financial protection. Option C. Advise the client that insurable interest is a prerequisite for a valid insurance contract, and explain that they would need to demonstrate a direct financial loss if the property were damaged to be named as the insured. Option D. Issue the homeowner's insurance policy with the client as the named insured, as they are initiating the purchase and wish to be the beneficiary. The correct answer is C. Advise the client that insurable interest is a prerequisite for a valid insurance contract, and explain that they would need to demonstrate a direct financial loss if the property were damaged to be named as the insured. Explanation. This scenario presents a professional challenge because it requires the agent to navigate the delicate balance between client needs and the fundamental legal principle of insurable interest. Misinterpreting or overlooking insurable interest can lead to policies that are unenforceable, potentially causing financial harm to the client and reputational damage to the agent and agency. Careful judgment is required to ensure that any insurance contract entered into is valid and serves a legitimate purpose for the insured. The correct approach involves verifying that the proposed insured has a demonstrable financial stake in the subject of the insurance. This means confirming that the individual seeking coverage would suffer a direct financial loss if the insured property or person were harmed. This aligns directly with the core tenet of insurable interest, which is a cornerstone of insurance law in the United States. Without insurable interest, a contract of insurance is considered a wager and is void as against public policy. The agent's duty is to act in the client's best interest, which includes ensuring the validity and enforceability of the insurance policies they procure. An incorrect approach that proceeds without verifying insurable interest fails to uphold the agent's fiduciary duty and violates regulatory requirements. Issuing a policy where the applicant has no insurable interest creates a void contract. This is a significant ethical and regulatory failure, as it misleads the client into believing they have valid coverage when, In reality, no claim could be paid. This practice can lead to regulatory sanctions, including fines and license suspension or revocation, and exposes the agency to potential litigation. Another incorrect approach that involves advising the client to name a beneficiary without a clear insurable interest, even if the applicant does, is also problematic. While beneficiaries do not need an insurable interest at the inception of the policy, the primary insured must possess it. Facilitating a structure where the ultimate recipient of the benefit lacks a connection to the insured risk can be seen as an attempt to circumvent the spirit of the insurable interest rule, potentially leading to disputes and legal challenges regarding the payout of claims. A further incorrect approach that focuses solely on the client's desire for coverage without investigating the underlying insurable interest is a direct abdication of professional responsibility. The agent's role is not merely to facilitate transactions, but to ensure they are legally sound and ethically appropriate. Ignoring the requirement of insurable interest is a failure to perform due diligence and can result in the policy being deemed void ab initio, leaving the client unprotected and the agent liable for misrepresentation or negligence. The professional decision-making process for similar situations should begin with a thorough understanding of the client's relationship to the risk being insured. Agents must actively inquire about and document the basis for the client's financial stake. If there is any doubt about the existence of insurable interest, the agent should consult with their underwriter or legal counsel before proceeding. Transparency with the client about the requirements of insurable interest is also crucial, ensuring they understand why certain information is needed and the implications of not meeting these legal standards. Question 17. Performance analysis shows that your agency's lead generation through social media advertising has increased significantly after implementing a new automated marketing platform. However, a review of the platform's features reveals it automatically generates ad copy and targets potential clients based on broad demographic data without explicit consent for data usage beyond initial engagement. The platform also has limited options for including detailed policy disclaimers. Which of the following represents the most professionally responsible course of action for the agency? Option A. Continue using the platform as is, assuming that the increased lead generation justifies the minor deviations from ideal disclosure practices and address any potential issues reactively. Option B. Immediately cease using the platform and revert to previous marketing methods until a fully compliant and transparent solution can be identified and integrated. Option C. Implement the platform but manually review and edit all generated ad copy to ensure compliance and add necessary disclaimers, while also developing a clear data privacy policy for client communication. Option D. Utilize the platform's automated features to maximize reach and engagement, and rely on the platform provider to manage any regulatory compliance aspects of the advertising. The correct answer is B. Immediately cease using the platform and revert to previous marketing methods until a fully compliant and transparent solution can be identified and integrated. Explanation. This scenario presents a common challenge for insurance agencies leveraging technology for marketing and sales. The core professional difficulty lies in balancing the efficiency and reach offered by digital tools with the stringent regulatory requirements for consumer protection, data privacy, and fair advertising practices within the insurance industry. Agents must exercise careful judgment to ensure that technological adoption does not inadvertently lead to non-compliance or ethical breaches. The correct approach involves a proactive and compliant integration of marketing technology. This means thoroughly vetting any new platform or tool for its adherence to all applicable insurance marketing regulations, including those concerning disclosures, prohibited practices, and data security. It requires establishing clear internal policies and training for staff on the compliant use of these technologies, ensuring that all marketing communications are accurate, not misleading, and contain necessary disclaimers. This approach aligns with the ethical duty of care owed to consumers and the legal obligation to operate within the regulatory framework, safeguarding both the agency and its clients. An incorrect approach that relies solely on the perceived effectiveness of a marketing tool without due diligence regarding its regulatory compliance is professionally unacceptable. This could lead to violations such as making unsubstantiated claims, failing to provide required disclosures about policy terms or limitations, or engaging in deceptive practices, all of which can result in significant penalties, reputational damage, and loss of consumer trust. Another incorrect approach involves the indiscriminate collection and use of consumer data through marketing technology without adequate consent or robust data security measures. This directly contravenes privacy regulations and ethical standards, exposing the agency to legal liabilities and eroding client confidence. A third incorrect approach is to automate marketing communications without human oversight or review, potentially leading to the dissemination of inaccurate or outdated information, or communications that are not tailored to the recipient's specific needs or regulatory protections. This demonstrates a lack of professional responsibility in ensuring the integrity of client interactions. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct when adopting and utilizing marketing technology. This involves a multi-step process. First, identifying the specific regulatory requirements applicable to the intended marketing activities. Second, evaluating potential technologies against these requirements, including their data handling and disclosure capabilities. Third, implementing robust internal controls and training. And finally, conducting regular audits to ensure ongoing compliance and ethical practice. Question 18. Implementation of a new client relationship management (CRM) system within an insurance agency requires careful consideration of how client communications will be managed. Which of the following approaches best aligns with regulatory requirements and ethical best practices for insurance agency operations? Option A. Utilizing a variety of unsecured messaging apps for quick client updates, assuming that clients are aware and accepting of this informal communication style. Option B. Developing a comprehensive agency policy that outlines secure methods for client communication, requires explicit client consent for various communication channels, e.g., email, text, social media, and mandates that all client interactions are logged within the CRM system. Option C. Encouraging agents to use their personal email accounts for client correspondence to foster a more personal connection, with the understanding that important details will be manually added to the CRM later. Option D. Storing all client contact information and communication logs on a shared cloud drive, accessible by all agency staff, without specific access controls or encryption. The correct answer is B. Developing a comprehensive agency policy that outlines secure methods for client communication, requires explicit client consent for various communication channels, e.g., email, text, social media, and mandates that all client interactions are logged within the CRM system. Explanation. The scenario presents a common challenge in insurance agency operations, balancing the need for efficient client communication with the regulatory and ethical obligations to protect client privacy and ensure accurate record keeping. Professionals must navigate the complexities of data security, consent, and the potential for misrepresentation when using modern communication tools. Careful judgment is required to ensure that all operational practices align with the Certified Professional Insurance Agent (CPIA) designation's commitment to ethical conduct and regulatory compliance. The correct approach involves establishing a clear, documented policy for client communications that prioritizes data security, obtains explicit consent for various communication methods, and ensures all interactions are recorded in the agency's official records. This aligns with the CPIA emphasis on professionalism, client trust, and adherence to insurance regulations, which typically mandate secure data handling and accurate record keeping. By proactively addressing these aspects, the agency demonstrates a commitment to both client welfare and regulatory integrity. An incorrect approach that relies solely on informal digital communication without explicit consent or documented procedures fails to meet regulatory requirements for data privacy and security. This can lead to breaches of confidentiality and potential legal repercussions. Another incorrect approach that involves sharing client information across multiple unsecured platforms without proper authorization exposes sensitive data to unauthorized access, violating privacy laws and ethical standards. Furthermore, an approach that neglects to maintain comprehensive and accessible client records, even if communication is happening, undermines the agency's accountability and can hinder regulatory audits or client inquiries. Professionals should employ a decision-making framework that begins with identifying all applicable regulatory requirements and ethical guidelines. This should be followed by assessing the potential risks and benefits of each operational practice, implementing robust policies and procedures, obtaining necessary consents, and ensuring comprehensive record-keeping are critical steps in mitigating risks and upholding professional standards. Regular review and updates of these practices are also essential to adapt to evolving regulations and technological advancements. Question 19. Which approach would be most appropriate for an insurance agent when presenting a new life insurance policy to a prospective client, ensuring both effective marketing and adherence to regulatory and ethical standards? Option A. Emphasize only the most beneficial aspects of the policy, such as death benefit payouts and potential cash value growth, while downplaying or omitting details about premium increases or policy limitations. Option B. Provide a comprehensive overview of the policy, clearly explaining its benefits, features, limitations, exclusions, and costs in a manner the client can easily understand, allowing ample time for questions. Option C. Use complex insurance terminology and technical details to showcase the policy's sophistication, assuming the client will understand the implications of these advanced features. Option D. Focus on creating a sense of urgency, highlighting the limited time availability of current rates, and encouraging an immediate decision to secure the policy. The correct answer is A. Emphasize only the most beneficial aspects of the policy, such as death benefit payouts and potential cash value growth, while downplaying or omitting details about premium increases or policy limitations. Explanation. This scenario presents a common challenge in insurance sales, balancing the need to effectively market a product with the strict regulatory and ethical obligations to provide accurate and unbiased information. Agents must navigate the fine line between highlighting benefits and avoiding misleading statements or omissions that could harm a client. Professional judgment is crucial to ensure client trust and compliance. The correct approach involves presenting a balanced view of the policy, clearly outlining both its advantages and disadvantages, and ensuring the client fully understands the coverage, limitations, and costs. This aligns with the fundamental ethical duty of an insurance agent to act in the client's best interest, and with regulatory requirements that mandate fair and accurate representation of insurance products. Providing a comprehensive overview, including potential drawbacks, prevents misrepresentation and fosters informed decision-making, which is a cornerstone of professional conduct and regulatory compliance. An approach that focuses solely on the most attractive features of the policy without disclosing potential limitations or exclusions is ethically unsound and likely violates regulations against misrepresentation. This can lead to client dissatisfaction, policy rescission, and regulatory penalties. Similarly, an approach that uses overly technical jargon without clear explanation can be considered misleading, as it prevents the client from making a truly informed decision. This failure to communicate effectively can be interpreted as a deliberate attempt to obscure important details. Finally, an approach that pressures the client into a decision without allowing adequate time for review and consideration undermines the client's autonomy and can lead to poor choices, violating the principle of acting in the client's best interest. Professionals should approach client interactions by prioritizing transparency and education. This involves understanding the client's needs thoroughly, explaining policy features in clear, understandable language, and proactively disclosing any potential downsides or limitations. A structured approach, such as using a needs analysis followed by a detailed policy review that addresses both benefits and drawbacks, ensures that the client is empowered to make a decision that is truly in their best interest, while adhering to all regulatory and ethical standards. Question 20. The analysis reveals that an insurance agent is considering integrating a new InsurTech platform that uses artificial intelligence to automate risk assessment for commercial property insurance. The platform claims to significantly reduce assessment time and improve accuracy by analyzing vast datasets. What is the most prudent approach for the agent to ensure compliance with regulatory frameworks and ethical obligations regarding risk assessment? Option A. Conduct an independent validation of the InsurTech platform's risk assessment algorithms and data sources, comparing its results with traditional methods and ensuring alignment with state insurance regulations before full implementation. Option B. Immediately adopt the InsurTech platform and rely on its automated outputs to streamline the underwriting process for all clients. Option C. Utilize the InsurTech platform for initial assessments, but defer to the insurer's underwriting department for final approval without independent verification of the platform's methodology. Option D. Prioritize the speed and efficiency gains offered by the InsurTech platform, using its recommendations as a primary basis for coverage decisions to meet client demand for faster service. Correct answer is B. Immediately adopt the InsurTech platform and rely on its automated outputs to streamline the underwriting process for all clients. Explanation: this scenario is professionally challenging because it requires an insurance agent to balance the adoption of innovative technology with their fundamental duty to assess and manage risk accurately for their clients. The rapid evolution of InsurTech presents both opportunities and potential pitfalls, demanding a nuanced understanding of how new tools impact traditional risk assessment methodologies. Agents must ensure that technological advancements enhance, rather than compromise, their ability to provide sound advice and appropriate coverage. The correct approach involves a thorough, evidence-based evaluation of the InsurTech tool's capabilities and limitations in the context of specific client needs and regulatory requirements. This means understanding how the technology integrates with existing risk assessment frameworks, validating its outputs against established actuarial principles and data, and ensuring it aligns with all applicable state insurance regulations regarding underwriting, data privacy, and fair practices. This approach upholds the agent's fiduciary duty to the client by prioritizing accurate risk assessment and appropriate coverage over the mere adoption of new technology. It also ensures compliance with regulations that mandate sound underwriting and prohibit discriminatory practices, which could arise from flawed algorithmic assessments. An incorrect approach would be to adopt the InsurTech tool without independent validation, assuming its outputs are inherently accurate. This fails to meet the regulatory requirement for due diligence in underwriting and could lead to mispriced policies or inadequate coverage, exposing both the client and the insurer to undue risk. Another incorrect approach is to rely solely on the technology's marketing claims without scrutinizing its underlying methodology or data sources. This bypasses the agent's responsibility to understand the risk factors relevant to the client and could result in a failure to identify critical exposures, violating principles of prudent risk management and potentially leading to regulatory sanctions for inadequate underwriting. Finally, an approach that prioritizes speed and efficiency over accuracy, using the InsurTech tool as a shortcut without critical review, neglects the core professional obligation to provide informed advice and accurate risk assessments, which is a cornerstone of insurance regulation and ethical practice. Professionals should approach such situations by first understanding the core principles of risk assessment and underwriting as mandated by their jurisdiction's insurance laws. They should then critically evaluate any new technology against these principles, seeking independent verification of its efficacy and compliance. A structured decision-making process would involve 1. Identifying the client's specific risk profile and coverage needs. 2. Researching available InsurTech tools and their purported benefits. 3. Conducting due diligence on the technology's methodology, data sources, and validation. 4. Assessing the tool's compatibility with regulatory requirements and ethical standards. And 5. Integrating the tool's insights into a comprehensive, human-reviewed risk assessment that prioritizes client well-being and regulatory compliance.